Good day, everyone. Welcome to another edition of Strategic Financial Management. In today's class, we shall continue with our lecture on valuation of a business, right? On a valuation of a business. Then the next method we're looking at was dividend-based valuation method. That was the method we are looking at, right? Dividend-based valuation method. Now, class, what do you need under dividend-based valuation method? Now, let's quickly check from the question what we were given about dividend. And don't forget, if you check the company income statements, it shows that it indicates that the company pay dividend, right? You can see the dividend from 2019, right, was 500. 2020 was 1,000, 1,000, right, which is 1 million, right? It means that there is a growth in the dividend. But the question says using the dividend-based valuation method, which means there is a growth in this dividend, right? Now, how do we now apply the growth in dividend? How do we apply the growth in dividend? Let's quickly go to the paragraph that talk about dividend. Dividend are expected to grow at the same rate as revenue, right? And what is the rate of revenue? We were told that if the acquisition succeeds, there will be the revenue synergy leading to increase in annual sales revenue of Zinco of 25% for 3 years. So which means that the dividend of 1,000 will increase. There will be a growth in dividend for 3 years. That is 1.12 raised to power. It's based on the numbers of years. 1.125 raised to power 1, which is year 1. 1.5 raised to power 2, that is year 2. And 10% thereafter. Don't forget, under the free cash flow, this 10% thereafter is the infinity. So you need to get for the 3 years, then you will now add from 10% per year, which is to infinity. You will now add it for you to get the current value of the business using the what dividend valuation method. So once you just see dividend, what it indicates is that this company pays dividend. They pay dividend. It's a dividend-based company. Don't forget, we have some company who does not pay dividend, right? But their investors depends on what shareholders what appreciation, right? And that is why we were able to raise the power of this the dividend by the what by the numbers of years. By the numbers of years. The 1,000 times 1.25 raised to power 1. And guess what? What will you use to discount it? This is dividend. You use cost of equity. And that is why we have 12% to discount it. It is given to us, right? That is why we do what? We use cost of equity to do what? To discount it, right? So that is why we say 1,000 times 1.25 raised to power 1, 1,000 times 1.25 raised to power 2, 1,000 times 1.25 raised to power 3, right? We do what? We raise it to power because the dividend will grow in line with revenue, right? And that is why we're able to achieve this. And don't forget, they say 10% thereafter. So you get the present value of the 25% increase for 3 years. Then you will now do what? Thereafter. That is 10% thereafter. That is infinity. Thereafter does not have, like, it is not 5 years, it is not 6 years, it is to infinity, right? So that you will not get the current value of the business. And that is why it is 6 marks. 6 marks. Right? It is not 6 marks, right? Now, so please confirm if these figures are correct. If it is not correct, please give me the correct figure so we can move on. Please give me the correct figure quickly.
Year 1 is 1,116.
1,001.
116.
116. Okay. Year 2.
That
Year
year one is
3.
not correct. 1116.
Okay.
Then year 2 is 1245.
Okay. 1245. 1245. Okay. Year
Year
3.
3, 1390.
12.
390.
123. 123.
1390. One
Okay.
one three
3
nine zero.
0.
1390. Yeah. Someone should
Okay.
confirm also.
Yeah, you are correct.
Okay. That's fine. That's a very good one. Okay. Please, what is the total present value? The total present value?
3751.
3751.
51.
No. This is from year 1 to year 3. Now, don't forget, it will increase 10% thereafter because the dividend grew in line with the revenue, right? So, infinity from year 3 to infinity. And don't forget, how do we normally calculate the infinity? Don't forget the way we did it under the what? Under the free cash flow. Is that not so? Don't forget the way we calculate it under what? Under free cash flow. So there are two methods I actually state there under two methods under the what is it called? Under the free cash flow, whichever way you want to use, right? We are still good to go, right? So you copy this last one, if you say 10% thereafter, it will start from the last year. Is that not so? So you can copy this and this last one raised to power 3. Then you multiply. What is the growth rate? 10%, right? Let's quickly go back and check what is the growth rate. The infinity. Class, can you see it? 10%. That is 1.1, right? Class, that is 1.1, right?
Yes, sir.
1.1. So we can have this as 1.1 coming. Okay. So 1.1 divided by the cost of equity minus the growth rate. Cost of equity. What is the cost of equity? 0.12. Minus the growth rate is 10%, 1.1. Right? Then times, of course, what will be the present value? Times what is the last DCF here? That is the last DCF. Please, someone should give me what is the last DCF here? Someone should give me the last DCF in year 3.
0.712.
0.712. Right? So 0.712. So you come and say 0.712. If you don't want to do it this way, you could say from infinity, you could say, or infinity will be calculated as, just pick this last figure here, this present value here. Pick it, right? Pick it here. And because your infinity will start from the last year, right? Times, you can grow it, times the growth rate, which is 1.1, 10%, right? Then divided by the cost of equity minus the growth rate. So what do you have? Do you have the same thing? Do you have the same thing?
Return
Please
value.
come. Figure.
Yeah, it's the same thing. 76.5.
Okay. Okay. What is the figure?
6.5.
76.5. Can you see it? And that is why we are next gen professional associate. So whichever method, whichever one you feel like to pick, you are good to go. So what is the current what is the current value? What is the current value? If you add the two together, what do you have? If you add the two together, what do you have? Current value. Or you say market value because it's in value, not in price. Market value. So if you add 3751 and 76.5, this other should also confirm the 76.5. So what do you have? If you add it together, what do you have?
3,827.5.
3,827.5.
827.5.
So this is the market value of the business. This is the value of the business. However, if you want to get the market, if you want to get the market price, if you want to just get the market price, just divide it by the numbers of shares, class. If you want to get the market price, just divide it by the numbers of shares. Just the market price equals to this 3827.5 divided by the numbers of shares, which is 40,000 shares, right? Which is 40,000 shares. So what do you have? What is the market price? What will be the market price? You know, we have to write reports, but let me just finish this calculation in first. So we'll now adjust some things. So what do you have? What is the market price?
0.1.
0.10
1.
naira, 0.1 naira per shares. Right? Per shares. Okay. Let's quickly confirm. Is our cost of equity 12%? Let me confirm this. I'm coming. Let me confirm. Is our cost of equity 12%? I need to. Okay. And the estimated cost of equity is 12%. Okay, that's fine. That's fine. Okay, who is that? The person should omit to use our mic.
So I don't know from my own calculation, I'm getting 76,484 for the
Okay.
3 to infinity.
Okay. I'm coming. To infinity. You are getting what?
I'm getting 76,484.
76,180.
484. 484.
184. Please, someone should confirm that again.
484.
Okay, 484.
Yes, sir. The previous figure is correct, sir.
Okay.
That we are approximated as. Good morning, sir.
Okay. Okay, that's fine. That's fine. Uh, that's fine. Now, let's quickly go back to the question. Right? Let's quickly go back to the question. And don't forget, mind you, don't forget that Don't forget that. Okay, okay, who is that? Olanike.
Good morning, sir.
Yeah, good morning.
If we approximate to 76.5, it will affect the figure. We've already approximated the 1,000, which is supposed to be 1 million. So approximating the 76 again will affect the value. That's what I think.
Oh, okay, okay, that's fine. So yeah, we have already approximate the, we reduce, it's supposed to be 1 million, the dividend, but we reduce it to 1,000. So in this place, we should not have abbreviated 76.5. We should have given the full figure. So just give me the full figure on that. Thank you for the observation. So just give me the full figure. The full figure, what do you have?
Me, I'm having 76,450. I don't know. That's what me I got.
So when you add it, what do you have?
8201.
8201. 8201. Okay, so we are good to go on this, right? Except those that are just joining us, that are just joining now, and I know them. Should I mention name? I won't mention, I won't call name. So we move to the next one. Based on the present value of expected future cash flows. Class. Don't forget we have to write reports. Let's just finish. We've already started the body of the report, and because of we have to pick formulas and all that. So at the end, I'll have to remove some formulas that were repeated. Then we'll put small notes, then recommendations. And we are done with these parts, right? And don't forget that, okay, the present value of expected future cash flows, the present value of the present value of expected what? The present value of expected future cash flows, right? Now, how do we determine the present value of expected future cash flow? Uh, Coming now, class. Pay attention to this part again. Don't forget, the financials given to us is 2020 and 2019, right? And if you are to present expected future cash flow is for 3 years, definitely you will start from 2021, 2022, and 2023. Or it is given, I think they gave us 2020 and 2019. Is that not so? Now, if you are to forecast for the future for the 3 years, you have 2021, because 2020, 2021, 2022, and 2023, right? Now, if you want to present the future cash flow, don't forget, we're told that if the acquisition succeed, there will be revenue synergy leading to increase in annual sales revenue of Zinco of what? 25% for 3 years. Class, we need to increase the revenue. by 25% for the 3 years, which is for the 2021, the 2022, and 2023 class. Now, this question was okay. Maybe when I won't say this thing on record. I will say something off record. Please remind me, please. Now, yes, it's recorded. So so we have to do for 2021, 2022, and 2023. So we have to first you increase the revenue, right? First, you have to do what? Increase the what? The revenue. Don't forget, this is the income statement given to us. Where is the income statement? For those of you that have the material, we check. You can see the income statement given to us. Is that not so? This is the income statement given to us, right? So we have to increase this revenue for 3 years by 25%. So we will have 2021, 2022, and 2023. Now, after that, what happened again? In the additional information, okay, we're told that the non-cash expenses, don't forget, since what you were given in this question, it is estimated cost of equity. It is estimated cost of equity. Something should come to your mind, right? Something should do what? Should come to your mind that this is free cash flow to equity. This is what? This is free cash flow to equity, right? This is what? Free cash flow to equity. The working capital, the non-cash expenses include depreciation were 4,100,000 in 2020. Income tax rate is 30%. Capital expenditure was 5 million in 2020, and it is expected to grow approximately the same rate as revenue, and the revenue will grow by 25%. So, which means that the capital expenditure, which is CapEx, your non-current assets, will increase by 25%. Can you see it? Working capital, interest, and non-cash expenses are expected to increase at the same rate of the revenue, which means that your interest given to you in the question, the interest, working capital, and non-cash expenses. What are the non-cash expenses? Depreciation will also increase. Zinco, we've treated this Zinco patent. Operating profits now is expected to approximately 8% of the revenue in 2021 and to remain at the same percentage in the what? In the future. Class, we have to present expected future cash flow. That is free cash flow to equity. So the question is, why are we have to use free cash flow to equity? Why not for the firm? Were you given weighted average cost of capital? No. The only estimated, the cost of capital given to you is 12%. Cost of equity, sorry, is what? Is 12%. So therefore, when you want to discount, you should know that, oh, you have to discount with equity. Then something should come to your mind again. Oh, if I'm to discount with equity, oh, this is free cash flow to equity then. If I'm to discount with what? With equity. So that is why you have to think. This is the present the value of expected future cash flow. Right? Now, we suggested solution. Okay. Number 5, right? Is it 5 or 3? 4, sorry. Present value of expected future cash flow, right? Don't forget, it is for 3 years, right? It is for what? It is for 3 years, right? Which means that it is for 3 years, which means that we have to do what? since it is for 3 years, we have to start from 2021, 2022, and 2023 because the last year was 2020, right? The last year was what? Was 2020. Now, we can now bring it this way and say this is 2021, 2022, 2023. Right? Please, presentation matters a lot. Please, presentation. Right? So we can have this here. Okay. The first thing is we're told that our sales revenue will increase. Sales revenue. Don't forget, from the income statement, okay, let me quickly check. Our sales revenue will increase. Let's check together. The sales revenue. If the acquisition succeed, there will be revenue synergy. We will get to merger and acquisition, whereby the reason why you have to merge is because of revenue synergy or cost synergy, right? Now, there will be revenue synergy leading to increase in annual sales revenue of Zinco of 25% for the 3 years. So we have to increase the revenue for 3 years. Now, let me quickly take us back to the income statement. And there's one thing I need to show. Now, in the income statement, don't forget, when you are valuing a business, exceptional item is excluded. Why? Because exceptional items are items that do not occur regularly, right? So therefore, we have to increase the sales revenue from 2020 now. 2020 is 112, 12,400. So we have to increase it by what? By 25%. Exclusive.
So, good morning. So, please, the last one you just did, that's the dividend method. Please, is it not 2 naira? 2 naira per share?
Please, you can just, that one is exclusive.
Because me, I'm saying 0.1. That's what I'm just saying.
Okay, that's fine. Who's that now? I'm in class. Oh. Sorry, please. I will join shortly. Sorry. Who's that now? Okay, sorry, please. Sorry. Exclusive. I'll correct that later, please. You get?
Okay. Thank you.
Okay, so we have to move. So let's quickly increase the revenue by 25%, right? Okay. 25%. Okay. So we increase it by 25%. So please increase this figure by 25%. What do you have? That is times what? Times 1.25. What do you have?
One
Times
140,500.
140. 500. So increase these two by 1.25.
175,625.
75625. Please increase this by 1 point.
219,531.
219
531.
531. Okay. 219539. Okay. So please others should confirm that if this is correct.
It's correct.
Okay. That's fine. Now, this is the what we were given, right? Okay. Now, don't forget that we were told that operating profits. Let's quickly move up. Let's check up. We're told that operating profits from the additional information. Where is it? Okay, operating profits is expected to be approximately 8% of the revenue in 2021. Can you see it? That you can see now that you have to start from 2021 and to remain the same percentage in what? In future years. Can you see it? So, which means that we don't know how they arrive at their operating profit. Is that also? We don't know how they arrive at their what operating profit, but they just told us that it is 8% of the revenue. So we have to, for you to get the operating profit, so it has to do with 8% of the revenue. So operating profit increase by 8%. Operating profit 8% of the revenue. So operating profit 8% of the revenue. So please figure, please. Figure
11,240.
11,240. Next
14,050.
14,050.
Hello.
Next
17,562. 562.
17,562. Okay, Pedita.
Hello, good morning, sir.
Yeah, good morning.
Sorry about my voice, so you manage it, please.
No, it's fine.
I thought they said the operating profit will remain the same after 2021.
Oh,
Why are we still inflating it?
oh. Do you know what it means?
No.
Interesting. Were you in class when we did the forecast? See, it will remain the same. It will remain the same is the percentage.
Okay, that's the
Pedita,
percentage of inflation will remain the same, not the
yes, will
figure.
remain the same, not the
Okay,
figure.
okay. Thank you.
Yes, thank you for that. Thank you. That's a very good one. Next, okay. The next thing is we need to check from the income statement. Don't forget, we want to determine profit after tax. You know, when you are doing your free cash flow, it is profit after tax. Now, sales now, to get the operating profit, they said it is 8% of the, ideally it's supposed to be sales minus cost of sales. You have opening, you have your operating profit, then you do your interest, you remove your interest, and you have your tax and all that. But in this case, we're told that operating profit is 8% of that. So the next thing we need to consider is, let's check from what we're given again from the additional information that we're given, as well as from the statement. So additional information, if you check from the additional information, where is it? Okay, additional information, working capital, interest payments, and non-cash expenses are expected to increase at the same rate as revenue. Your interest payments will increase. Now let's check what we're given from the income statement. Let's check from the income statement. Don't forget your exceptional item is 0, so you don't need to include it. So the next one is interest paid. And don't forget, we were told that the interest payment will increase with the same rate of, we are the same rate of what? As revenue. Don't forget, what we want to calculate is profit after tax first before we start our free cash flow. Is that not so? So this is interest, right? This is what? This is interest. Where is it? Where is it? Okay, this is interest paid, right? So we have to increase it at the same rate of what? Revenue. So we'll bring it here. We'll bring it to this side. So interest, so increase 1.25 on a yearly basis. So what do we have?
1750.
Okay, that's fine. 1750. Please increase it again by 1.25. What do you have?
2188.
2188. Next,
2734.
2734.
734.
Okay, that's fine, right? So after that, what do we have again? I don't think we have any other information given to us, right? I don't think we have any other given to us from the income statements apart from, okay, then profit before tax, before the taxation. Okay, that's fine. Profit before tax. So profit before tax. So when you deduct this from the operating profits, you have profit before tax, profit before tax. So profit before tax. So what is your profit before tax? Quickly.
9490.
Okay, I'm coming. 9490.
11862.
11862. Next.
14828.
14828. 14. Rachel.
Yes, sir. Good morning, sir. Hello, can you hear me?
Yeah, I can hear you.
I thought you said we are using free to the equity, sir.
Before you calculate free cash flow to the equity, sure you will get profit before tax.
Yes, sir. Yes, sir. That's true, sir.
Interesting. You did well done. So if you want to calculate free cash flow to the equity, you have to calculate profit before tax. Profit after tax. So when you get your profit after tax, then you can now apply the principle. You get, so sometimes it will not be like already made question, just like free cash flow, the one we did the other time. well, they already given us what is it, or they gave us the profit after tax, then we just use it, right? We do add back and all that. Sometimes you just have to restructure it, just like this. You have to restructure it again. Hold on. So now, if this is established, the next thing is the tax. Don't forget the tax is 30%. Tax is 30%, right? So the tax is what? The tax is 30%. Let me say
I think the second year is 11,862.
the difference.
Yes. 14,050 minus 2188. It gives 11,862.
Yeah, it's 11862, sir, not 1862. It's 11.
Okay, 11,862. Okay, that's fine. That's a very good one. Well done. So the tax. What is the tax? 30%. What is the 30% of all this? Quickly.
2847.
2847. Okay.
3550.
3550. 3550.
No, 9. 3559.
Oh, sorry, 9 Adam.
Okay, next.
4449.
444. Okay, so what is profit after tax? Profit after tax.
Right, 4448.
Okay, I'm
Yes,
coming.
ah,
The first one is what?
6643.
6643. Next.
8303.
8303. Next.
1038.
Can we do this one, please? Can we change 9 to 8, please?
Which one of which this?
4449 is 4448. The last one.
Okay. 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 Any other thing again? Are we good now?
Yes, sir.
Okay, that's fine. So this is profit after tax. What next? From our format, I expect you to have memorized the format of free cash flow, right? Free cash flow. So in this case, we add back non-cash item, and don't forget this is add non-cash items, and don't forget this is free cash flow, right? So equity. So there is no interest, right? But this is free cash flow to equity. So now let's start. What do we have? What do we have there? Which one should we bring in? Capital expenditure, right? Okay, non-cash item. Let's use depreciation. Is depreciation mentioned to us in this question? Let's check. I think it was mentioned. Class, are we still together, please?
It was mentioned.
Okay, okay. So, depreciation. Okay, it was mentioned. That is non-cash. Non-cash expenses include depreciation. Can you see it? And don't forget that this is for 2021, 2020. And we were told in this paragraph, look at this paragraph, that the non-cash expenses will increase in the line of what? Revenue. So this figure here, we have to increase it by what? 25%. Right? We have to do what? We have to increase it by what? We have to increase it by 25%. So we go back and increase it by 25%. So we have depreciation, right? Depreciation. Before we create another link, depreciation times 1.25. So we are, so this is this. So we have to increase it, right? All right. So let me quickly create another link so that we can join. Then we'll continue with our lecture. Thank you. I can't sit. I can do it too. I can't just sit and do a report, right? For the student. I can't do that. I will tell you that I'm not the one writing the exam. You are the one writing the exam. You see that class that we are analyzing, we are doing this, we are doing that. You must be in that class and you must write. Guess what? I will not even send that material to them immediately after this class, after the class, because you have to write. You are the one that want to write the exam, not the one, right? So that is how it works, so that you will learn. So please increase the depreciation. What do you have? If you increase the depreciation, what do you have?
5125.
Okay, I'm coming.
25.
5125. Okay. So what do you have again?
6406.
6406. What do you have again?
8008.
8008. Right? We are adding back non-cash items. Is that not so? So this is free cash flow to equity. I think it is to the firm would have add back interest, right? Would have add back interest. So if this is the only non-cash expenses that we have, excuse me, we move on to capital expenditure. Capital expenditure. Don't forget in the question, we're told that capital expenditure, we're given one figure for 2020, then it is to be, we have to increase it. We have to increase that capital expenditure by a certain percentage, right? By a certain percentage. So we quickly check, where is it? Capital expenditure. Now, the capital expenditure was 5 million in 2020. So this is 5 million in 20. I expected to grow at approximately the same rate as revenue, and the revenue will increase 25% per year, right? 5 million, and the revenue increase 25% per year. So we can have 5 million, which is 5,000, times 1.125. So figure, what do you have here?
6250.
Okay, 6250, right? So they
Yes.
say it will increase. You can see that your capital expenditure is increasing. Is that not so? From 5,000, it will increase to 6,250. Is that not so? That is an increase. It will reduce your what? It will reduce your what? Your cash flow. Is that not so? Next, what is the next increase? Increase 6,250.
7813.
7 what?
813.
7, 8, 1 what?
13.
1, 3. So what next do we have?
976.
9 what?
7.
9, 7. 6. What do you say?
6.
Okay. Please, can you be audible? Who is that? Is it
Okay.
Clement? Clement, right?
Yes.
Okay. Thank you. Now, please, Sean, please confirm all these figures, right? Please confirm the figure, right? Please confirm the figure. Now, if this is established, after you add back non-depreciation, your capital expenditure, if it is increased, you can see that there is an increase in the capital expenditure. Now, the question now is, what next? There is an increase in capital expenditure. What other, do we have working capital given to us in this question? Working capital.
Yes.
Let's check. Thank you. We're told that working capital, interest payment, and non-cash expenses are expected to increase. We already increased the interest. We've increased the non-cash expenses and the working capital, right? We increase. So in this case now, are we given any working capital? We're not given the figure, right? Are we given the figure of the working capital? Is the figure of working capital given to us? No. So that means we have to look for the working capital, right? Okay, let me check again. Non-cash expenses, capital expenditure, working capital, operating, okay. So which means that we need to do the working capital, right? Uh, Class, are we still together? We need to do the working capital, right?
Yes, sir.
Yeah. So, working capital is total, is current assets minus current liability. Is that not so? Hello? Ah,
Yes.
100.
Yes, sir. Yes, sir.
I beg now. Or let me show you. Oh, working capital is our current assets minus our current what? Liability. Can you see it under the free cash flow? Can you see it? And our current assets exclude what? Exclude cash. Is that not so? Then we'll just look for the one of 2020 so that we'll now increase it in line with what? In line with the revenue. So quickly, the current assets, inventory, please pick inventory, 7,000. Have you picked it? 7,000. Then pick, where is the inventory? Okay, pick receivable, receivable. Don't forget is exclude cash. Is that not so? Have you picked it?
Yes.
Okay. Now, what about the current liability? Okay, this is the current liability, 27,600 payable. Have you picked that also? Okay, okay. So now let's arrange it. Let's show the workings. Let's show the workings on the working capital. Working capital. It will increase. We don't know the figure. Let me just say working determination of working capital. Determination of working capital 2020. Sorry, I always want to follow this so that, okay. So the current assets, add the, okay. So we have inventory, inventory. What is the figure for the inventory?
17,000.
17,000. 17,000. Inventory 17,000. So receivable is what? What is the receivable?
13,790.
Receivable is what? You say
13,790.
18,790.
13.
Okay, 13. Thank you. Next. So we have current liability. Current liability, which is payable. So what is the current liability given to us?
27.
27,600.
27,600. So when you subtract your current asset minus your current liability, what do you have? Working
319.
capital. What do you have? What do you have?
3190.
3190. Excuse me. 3190. Right? So this is 3190. Okay. You know, under the free cash flow, you have what is it called? Changes in working capital. Under the free cash flow, you say changes in working capital. You have to compare maybe 2020 to 2019, for you to get changes in working capital. Is that not so? But in this case, we were given already. In this case, we're told that the working capital will increase in line with the revenue. That is the increment. That is the what class? That is the increment, right? So we need to increase the working capital by 25% given to us in the question, which means that we need to increase it by 25%, right? So 3,190. So we increase it, right? We increase it. So we move to this part and we write working capital 3,190 times 1.25. What do you have?
39888.
3988. 3988. Okay, let's do it this way. Okay. Interesting. Don't worry. Interesting. So 2020, let's do something. That figure is too high. Let's do something. I'm coming.
So sorry, I thought we would take the changes in the
2020,
working capital we are going to pick
2021,
is the changes in working capital, the increase. Okay.
2022. I'm coming, please. And 2023, right? And 2023. Okay. So the working capital year zero is 2020, which is 3,190. So we have to increase it by, I think, uh, any question, please?
Sir, please, can we put that current
Is it,
liability in brackets?
okay. I will do that now. Is there any other question? Please, any other question? Okay, thank you. So, current assets minus current liability. Okay. Okay, so what is the increase? If you increase it by uh increase 25%. How many percent, sir? 25%. Okay. Coming. Okay. So this is assumed to be year 0, right? So now when you increase it, increase 3190, jack it up by 25%. What do you have? What do you have quickly?
3988.
3988.
88.
I can't hear you, please. Someone should just
3988.
okay. Our favor. Why you gonna use bedroom voice for me now? Okay. 3988, right? Because that figure.
Yes,
Okay,
3988.
next. Okay, thank you. Next.
4984.
4984. Next.
85.
7788.
7788. Okay.
No, sir. Please, the last figure is wrong.
6231.
6230.
Let's do it this way. Olanike, are you still in this class? Esther, are you still in this class?
Yes, I'm here.
But you're not talking now.
I'm a little bit tired.
What about Esther?
Yes, sir.
Okay. Then I just need three professional students to just give me the figure, like just three. One person, Esther, Olanike, and Isaiah, please. So please, thank you. So please, what is the correct figure for this?
I
The
got
last one is not correct.
So what do you have?
6231. My presentation.
6231.
It's 0.4. So where's the approximation coming from?
48.
6230.
Approximate further.
Please, what is the total figure that you have in 2023? What is the total? What is the total figure in 2023? From here, what is the total? The problem is this: am I approximating or not? Just give me what is the total figure. Let's see.
6230.
6231.25.
I'm coming. 6231 point what?
25.
0.25. No, this is
Actually got
correct now.
6230.4. And
62
0.4.
what?
I got
62 what?
6230. 6230.4. I don't know. That's what I got.
I don't know how you arrive at that. I don't know. She is 0 and 1. Please, let's move ahead. Predictor, right? So, what is the changes in working capital? So, please, how many people, if you know you get this 6,231, let me see your hands up. Let's see if this is correct, right? So, it could be from your calculation.
Excuse me.
So, are we good? Okay.
I guess the calculation is actually correct, but the problem is once you start from the first one by doing the 25%, I don't know the 25%. If you don't like what they do, what I notice is if I continue like that without approximating, it will give me 6230.4. But if I use this one that I've approximated in 2020,
Okay.
it will give you different. It's just because of that approximation that's giving the difference in this.
Approximation. Oh,
So
okay,
it's not really a
okay, okay,
problem like
okay.
that.
Okay, okay. Thank you. Thank you. Thank you. That's a very good one. Well done. So it means you have to be consistent. If you are approximating, you approximate. If you don't want to approximate, you leave it that way. So changes in working capital. So what is the difference? Don't forget that what is our changes in working capital? You can see this is assumed to be year zero. Is that not so? So from from 3190, it increased to 3 3,988. Class, what is the increase? The increase is the difference. What is the difference? What is the difference?
798.
798. Now, can you see that from 2021? Oh, let me see. You are in this class. I don't know that you are in class. So well done. So from 3988 to 4984, you can see it increased. Is that not so? So what is the increase?
6.
What do you have?
996.
996. Okay. Please, mute your mic now, please. Next, what do you have?
1247.
What is it?
1247.
1247. So can you see the increase? So do you know why I quickly say no, this is wrong? Because I'm looking at that figure. No, that figure is kind of high for working capital. No, now we're supposed to look for the increase, right? Just like the way we usually do under the free cash flow. Maybe year zero or 2020, maybe year one, year two, year three. We say from year one to two, we look for the increase. Is that not so? And that is what we did under that. So the 2020 is assumed to be what? Year zero. So we can quickly copy this part and move it, right? So we can copy it to this side. We've done it already. So we can refer to, we can say work one. So I can copy this part to this. Mr. Moses.
Yes, sorry, sir. Good morning once again. Please, I was thinking that at the last year of working capital, we have to recoup and not protect the changes. I thought we are going to recoup the whole working capital at the last year of the
Okay.
project.
Okay. Is it a project we are doing? Is it a project? First, let's establish that. Is it a project? This is not a project. We are valuing a business,
Yeah,
right?
yes, we are valuing
What
it.
we want to determine is increase or decrease. So when we get to capital investment, you can say, oh, at the end of the project, Mr. Moses, you recoup back your investment. But this is free cash flow. This is cash flow, right? I want to get the increase because the increase indicates that there will be a decrease in my cash flow, right? That
Thank
is
you
it.
very
Thank
much.
you.
It's clearer now. Thank you,
Thank you.
sir.
Preston, I like that. So this is working capital. Do we have any other thing? I guess no. I guess we've treated all the adjustments we need to do, right? We're not given any information about their borrowing, right? Don't forget, we're not given any information. Although under the free cash flow to equity, you need to include total borrowing, but we were not given any information as per their borrowing, whether their borrowing will increase by 20% in 2021, 2022, and 2023. No information was given with respect to that. So therefore, we move on. Class. So therefore, we move on. Right? So now, what is the free cash flow to equity? Quickly, And what is the free cash flow to equity? What is the free cash flow to equity before we now discount? Free cash flow to equity. What is the free cash flow to equity? So, Peter, no class. Sorry. So please figure.
The first one is 4720.
Okay. 4720. 4720.
The next one is 5900.
5900.
Then
Next.
7375.
7375. Okay. So class, this is your free cash flow to equity. But what next? We need to discount it, right? So you can say DCF, you use the cost of equity to discount. When you discount, you have your present value, which is the value of the business. So please, the first year, so you assume that this is year one, this is year two, and this is year three, right? So what is the DCF for year one?
0.893.
Okay, 0.893. Year two,
0.797.
0.797. Year three,
0.712.
0.712.
2.
Okay. Okay. So what is the present value when you multiply? What is the present value?
4215.
4215.
4702.
You say
The next one 4702.
4702.
And
Next,
5251.
5251. So what is the total? Let's get the total value. Let's add everything together. We can get the total, right? Um, coming total market value from 2021 to 2020 to 2020 what sef? 2021, 2022,
3.
2023, right? So what is the total?
14168.
Okay, don't forget it's a million. We could do this way. 14, I'm coming. 14 what?
168.
14,168. Now, are we done with this? The question is no. We are not done, right? Now, don't forget, we were given that the revenue will increase. Class, the revenue will increase by 25% for 3 years and 10% after. So what is it? It means is that you will still have to infinity. Class, you will still do what? You will still have to infinity. That is what it means. Because if your revenue increase, because you cannot do the infinity together with the revenue. No, what give you the profit after tax is from the profit after tax. Is how did you arrive at profit after tax? Is from your revenue, from your operating profit. So you have to do the what? The 10% thereafter. You cannot do it together. That is why you have to do 25% first. Then you will now do to infinity. That is 10% per year thereafter. So therefore, we can move it this way. 10% per year thereafter. So infinity, 2023 to infinity, right? So this is our last. Don't forget, you always pick your last cash flow because it is from that 2023. You pick it. It is from 2023. Is that also? Always pick the last what? The last cash flow. So in this case, this is the last cash flow. Is that also? You bring it here to infinity times it will increase by 10%. By 10%. Is that also? 10%. Right? Divided by the cost of equity is 12% minus what is the growth rate? What is the increase? Is 10%. And don't forget, you have to, what will be the DCF? The present value. The DCF times the last, don't forget, the last DCF, the last year DCF. This is it. So you can copy this and use it here, right? So this will give us the infinity. So class, what is the infinity figure? What do we have? Quickly.
I'm having 205629.
Okay. Please, others should confirm 205269. So when you add, what is the total? If you add it together with this, what do you have as the total?
So that is 205629.
205629. So what do you have here?
219797.
219797. Class, this is the total market value. If you want to get total market value, total market value, I'm coming. Total market value. This is the total market value, right? And this is the total market value. Okay. So any question? Mr. Moses, quickly, please.
Yes, sir. Sir, sorry. The 2023 infinity value, we picked discounted value already. Why are we still discounting it? The value we picked, the last year
Oh,
value,
okay.
5251, is discounted already.
Oh, Okay. Thank you. Thanks for the observation. See, thank you. We've already discounted it already, right? So why should we now bring it forward? We've already discounted it to be 521. Unless if you want to bring in the real figure, which is 7737. You can bring in the real figure of 737. So why do we multiply again? Right? So we don't have to do the multiplication. This is it. Or you could bring this forward. This is it, right? Then you grow it times 1.1 divided by divided by, thanks for the observation, divided by this, right? Divided by this times okay, 0.712. So when you do it, you have the same figure, right? You have the same what? Figure. Class, who is against me in this class? If you know you are against me, let me know. Where is Mr. Samson? Mr. Samson, are you still in this class?
I'm around, sir. Fully on ground.
Ha, active.
Yes, sir.
Well done. So,
Yes, boss.
so please, who is your boss? They play. So please, if you have question, are we good?
So we
Are we
need to
good?
change the figure now.
Okay. That's fine. That's fine. That's a very good one. Okay. Just
The
give me the figure. What do you have?
288805.
288. Mm-hmm.
805.
835.
05.
Okay. What do you have here? Figure.
302973.
30
2.
302
973.
903
973.
7. Ah, sorry. 302. Mm-hmm.
973.
Oh, thank you. One bottle of Coke for you. One bottle of Coke.
Thank you, sir.
Yeah, okay. So we are done with this question, right? You can see it's very simple, right? It's just for you to understand what you want to do, right? It's just for you to do what? To understand what you want to do. So once you understand what you want to do, then you are good to go. So we are done with this part of the question, right? So now they say we should write a report, so you will complete the report. What I will just do, I will do recommendation. I've assumed that I'm writing a report with all these figures. I'm assuming that I'm writing what? Report. Now let me show you something here. Uh, before we move to the next one. Now, when you look at all this from the asset-based method, the asset-based method gave us 76 million, gave us 76,330,000. Please take notes. And which one again? And using the dividend valuation, okay, using price earning ratio, it gave us 106,800,000. While using dividend valuation method, we have 80 million, right? Then under the free cash flow, we have 302 million. You can see that in all this, the free cash flow, right? the total market value, the value of the business is higher than others using what? Using the free cash flow. However, even if the asset-based method, if the asset-based method is higher than the free cash flow, you can't even recommend it, right? You can't recommend it. Even Zinco PLC board of director will not accept that bid. We never accept that bid, right? We do what? We never accept that bid. If you want to value it, you now say, oh, because it's higher, you want to use asset base. They will never. Now, in theory, you increase a cash flow by a certain amount, by a certain percentage, right? Now, what is your basis of analysis? What, you know, especially in Nigeria economy that is not stable, and you are hoping that the revenue will increase by 25%. What if there is government policy that distorts, that will affect the business, just like the recapitalization? Banks, financial institutions are not even expecting that, right? But guess what? It actually disrupts some of their operations. They have to go through right issues, right? They have to go through right issues. They do a lot of right to meet up with the what? With the policy. So therefore, the best method for this, for in theory, now, you will recommend the free cash flow to them because it has the highest what? Highest total market value. Highest what? Highest total market value. Don't forget, in your report, you could equally state under the PE ratio that PE ratio is subjective because it makes use of what? Accounting profit. It is should form part of your what? Part of your report. Guess what? Examiner just want to see how you arrive at all those figures and how you can be able to write small thing about it. Then you recommend, you move on. And that is all. So therefore, we have to recommend, right? We have to recommend. So recommendations. And don't forget, in our introduction, I state something in our introduction. Class, please, for those who are here to currently we have about 11 students has actually take advantage of the opportunity. They've paid for the pre-sim. And guess what? I have three tasks to give to them before the exam. Three tasks, right? I gave one yesterday. And guess what? They will report to me. They will give me the report on Sunday because we will meet on Sunday. They will give me the report on Sunday. That is first task. In the subsequent week, I will give them another task, which is 2. Now, this will enable them to have an idea of report writing. I will equally share my report, my previous report that I have a client in the UK. I did a report on a portfolio. I sent to her. I will send the recommendations as well. Guess what? You are in the right place when it comes to case study. When it comes to strategic case study, you are in the right place. Guess what? With Next Gen Professional Associates, anything that has to do with analysis is gone because we have an understanding, not theory. It is practical of it. So please take advantage of this opportunity. Pay, right? Look for a way. We know it is not easy, right? It is not easy, but look for a way to pay. Once you pay it, right, you will see the benefits. So, and let me now tell you something again. Yesterday, I received a call from CITN students, Chartered Institute of Taxation of Nigeria, right? Big boys, big guys. They say, oh, IB, we know, okay, come and do analysis for us, right? I will equally take them on their strategic case study as well at the final level, you see? So why is the recommendation coming? It's because they know that it is what I've been doing, report writing, right? So please take advantage of this opportunity. It is not compulsory. If you want, fine. If you don't want, fine. So please take advantage of this opportunity. Now, look at my introduction. Your introduction should include what they see. You should in report writing. Your introduction should include what they ask you to do, right? What they ask you to do, right? The question says that we should value it based on the asset base, PE ratio, dividend valuation, and that is why we have to say, oh, this report, we could say this report provides the valuation of Zinco Limited using the asset-based PE ratio, dividend valuation, and present value of future cash flow for the 3 years under review. The report also represents a recommendation on the basis. You can see you have equally stated the recommendation, which means that your recommendation should also form part of your reporting. Now, you've equally stated in your introduction that it is asset-based method. Now, you can see Roma figure 1, you talk about asset-based. Roma figure 2, you talk about PE ratio. Roma figure 3, you talk about dividend valuation method. The next thing, you talk about the present future cash flow. Now, recommendations, class. So now let's quickly recommend before we quickly move to another question. Before we go to another question, it is very important. At least we need to solve 3 questions. Okay. Recommendations. Now, and you should also know that even in okay, let me just put it this way. It is of let me use this way from the analysis above on the valuation of Zinco Zinco Limited from the analysis on the valuation of Zinco Limited, the minimum value should be present value of not the minimum, sorry. Okay, let me do minimum, then I will do our maximum as well. Okay, the minimum value should be the present should be okay. Now, class, please confirm, are we still together? Please,
Yes,
are we
sir.
still together? Class, are we still together? Okay, that's fine. So now, what I'm trying to say here is that from the analysis above, on the valuation of Zinco Limited, right? Of Zinco Limited, the minimum value, minimum means the lowest value. Now, when you look at all this now, present value give you 302. This gave us 880. Is that not so? Which one is the lowest? That is the minimum. This gave us 106. So the minimum should be asset based. Okay, the minimum is 76, right? 76,310,000. So therefore, you can state it. You can equally state the minimum value. The minimum value is assets based value of what is that amount self? 76 what? I think
Okay.
76,300, right? Yes. And the maximum and the maximum value is the present value of future cash flow of 3 of 302,973 million, right? Therefore, or you say furthermore, or you say therefore, the bid of Zinco, okay, therefore, all other methods should be ignored except the future cash flow method. However, it is impossible to produce an accurate valuation. That's all. Should be ignored, right? We have to do what? We have to ignore, should be ignored all other methods. And this is all about it. Professional colleagues, are we there?
Yes,
Are we
sir.
there?
Yes, sir.
And
Okay.
this is what we do. Thank you. This is what we do at Next Gen Professional Associates, right? You can decide to put it in your own format. See, write it the way you will understand. Is that not so? Now, and that is all. So thank you. So we need to move to the next question, right? Do we have anyone that have any observations before we move ahead? If you have any of the observations, please unmute your mic and ask your question. There are a lot to say. There are a lot. Guess what? There are a lot to say.
Sir,
Okay.
sir, please, why do we ignore the assets based method?
Is historical. You cannot see exclusive. Exclusive. Excuse me. Let's be practical here. You have a business, right? No, excuse me. You have a business that it has been in existence, and someone now come to you that I want to buy this business. Then you bought a lot of assets, you've been making profits, you've been running the business, and someone say I want to buy this asset, and the person now comes to you that I will value your business based on asset base, historical, based on the amount you bought the assets. Will you accept that? As a business person, will you accept that? No, it is not realistic. It's in practice. You can't even try it. Nobody will accept your bid. So please, you have the material. Please, everybody, most of you have the material. Read it and go back and listen to the video on the introduction or valuation of a business. I've mentioned so many things about asset-based, PE, dividend-based method. Please, it's very important. Exclusive, do you get that?
Yes, sir.
Thank
Sir,
you.
sorry,
Yeah, I'm with you.
I'm asking too much question today.
Please, quickly, so
Okay,
we can
sir.
move.
Sir, please, in writing our reports, after introduction, is it still cool for me to say after my introduction, I now say the following are the summaries of my findings, maybe asset base, I just put the value, P ratio, put the value down to this thing.
Oh, sorry, this call. Okay, so this is another question adopted from ACCA as well as ICANN. Please, let's pay attention to this question as well. Estimate the share price of Obong PLC today. Now, when they say share price means market price. Class, share price means market price. Market price, market price. Share price means what? Market price. Now, if Obong PLC accepts the bid from Abdul PLC, it is expected that the new growth rate will rise to 12% for the first 3 years. Right? It is estimated that the new growth rate will rise to 12% for the first 3 years. So there will be a growth rate for the first 3 years, year 1, year 2, year 3. And thereafter stabilize at 7%. That is what? That is infinity. So which means that, don't forget, valuation of a business, merger and acquisition is a form of valuation. Economic value added is a form of valuation. Shareholder value analysis is a method of valuation. The free cash flow is a method of valuation. Enterprise value is a method of valuation, right? Now, bid, they want to do bid. Probably they want to acquire, Obonge want to, maybe Abdul want to acquire Obong PLC. Is that not so? So you can still use valuation when it comes to what? Acquisition. Now, calculate the new share price to the shareholders of Obong PLC, which means that if you want to calculate the market price, what is the formula? Don't forget, there will be a growth for three years, 12%. Then 7% thereafter. We give you the share price. We give you the share price. So definitely you inflate, then infinity. Now, as a financial advisor, recommend to the shareholders of Obong PLC whether the offer from the Abdul should be accepted. So you need to look at it. When the offer increases or when the offer did not increase, what is the difference? Before they can be able to accept, there is one thing called in merger and acquisition. I will remember something takeover. So as a financial advisor, I recommend to the shareholders of whether they offer to accept. So you need to recommend. Now another thing is, according to efficient market hypothesis, I've sent the note on efficient is under valuation of a business. Please, you need to read that part as well. It's very important. According to efficient market hypothesis, it is believed that the market would react instantly and accurately to the merger announcement between Obong. Yes, hostile takeover. Thank you. That is a very good one. So instantly and accurately to the merger announcement between Obong PLC and Abdul PLC. Of course, class, professional student, professional colleagues, because we are both professional colleagues, right? We are both professional colleagues. Now, when company A want to merge with company B, there will be a certain reaction in the market, right? When we get to merger and acquisition, we'll discuss about that. Now, define briefly the 3 forms of EMH and their implication to the market. So please go back to the notes. For those who have the material, go back to the notes, understand EMH, and as well as the implication. I will leave that question for you. D. So let's quickly read the question. I'm coming. Obong PLC recently received a takeover bid, right, from Abdul PLC. If the bid for Obong PLC is successful, it will provide Abdul PLC the needed competitive edge, because one of the reasons why you acquire business, right, is it could be because of revenue synergy, it could be because of cost synergy, it could be because of access to raw materials, it could be because of competitive advantage, it could be because of innovation, it could be a lot of things, right? Because question may also ask you that, okay, why do we have to acquire this business? Why? Now, in research and development, to expand its laboratories in into the production of the COVID vaccine. Now, the shareholders of Obong PLC will only accept an offer that meets a required return of what? Of 14%. So when you're talking about, don't forget, what is a required return? That is a return on equity. That is CAPM. Don't forget, at the beginning of our lecture, I said I've mentioned it. Even in portfolio theory, if you have watched the video on portfolio theory, I mentioned it that CAPM is required return that you are expecting. Required return. If you watch the video on portfolio theory, required return of 14% on their what? On their current what? Shareholding. Upon PLC recently paid a dividend of 20, and this is expected to grow at the rate of 7% for the foreseeable future. What is the required? So the required says that we should determine the market what? We should determine the market, the share price. So when you want to determine the share price, they are talking about dividend. And don't forget, the dividend, there is a growth in this dividend. Class, is there not growth in this dividend? Class, is there not growth in this dividend? They say there is a growth in dividend. The dividend will grow by 7%. And don't forget, at the beginning of our lecture, in valuation of a business, I give a formula under dividend valuation, that is how to determine the market price under the dividend valuation with growth as well as without growth. So we'll copy the formula, right? We're going to copy the formula, then we'll determine the market price, right? Using the what? The dividend with growth, because the dividend will grow by what? 7%. And that is what they see is true. That is 2 marks. So now let's quickly check. Let's quickly go back and check. Oh, coming valuation. Please. Okay. So can you see it? Dividend with growth. Right? Can you see the formula? Please, you must know this formula. Please, you must know this formula. Dividend with growth. So you can copy this and we bring it down. A. So this is the market price. Is equals to DO. So the market price equals to DO. That is the DO. Don't forget, what is DO, class? What is DO?
Current dividend.
That is dividend. Thank you. That is 20 naira. Open bracket 1 plus growth rate. The growth rate is 7% divided by the cost of equity. Once you just see in a question, they say it is takeover. It is takeover. And the question says you should determine the market price. See, don't even think twice. Know that this is valuation. The first thing that should come to your mind, which on which basis of valuation which method of valuation, right? And they just mention dividend to you. They just do what? They just mention dividend to you. So you don't even need to think twice. Oh, there is a growth. And quickly say, oh, market price, that is share price. Then ask yourself, then fix it, right? So growth rate, growth rates, coming, growth rates. So what is the cost of equity? I think the cost of equity here is 7%. Can you see it? Sorry, 14%. Can you see it? The cost of equity is what? Is 14%. So that is 0.14 minus the growth rate of 0.07. Class, what is the price? What is the market price? What is the market price?
306 approximately. 06.
306 naira per shares, right? Per what? Per shares. So this is the market price. We are done with this. And this is 2 marks. The next is B, shares. So let's check. What is the B part of this question? If Unborn PLC accepts the bid from Abdul, it is estimated that the new growth, now there will be a new growth in dividend. There will be a new growth in dividend. We rise to 12%. So for 3 years, so the dividend will now grow year 1, year 2, year 3. Don't forget, when you are growing dividend, right? When you are growing dividend on a yearly basis, when you are growing dividend on a yearly basis, of course, you need to discount it, right? When you are growing the dividend on a yearly basis, just like what we just did, when you are growing a dividend on a yearly basis, of course, you have to discount it to the present value. So the question is, what will you use to discount? Is what is cost of equity? Is that not so? And the cost of equity is given to us as for what? 14%. So we increase it, then we do what? To infinity. So we add the two together, we have our what? We have our what is it called? The new share price. And that is another 2 marks. Class, am I communicating? Are we together? Or are we tired? Okay, that's fine. That's fine. That's fine. Okay, let's quickly do that. Quickly. Okay. Uh, Dividend. Okay, how do we normally do this thing? Oh, year, right? We have year items. We have the cash flow, the DCF, which is 14%, the PV. So this is, so it will increase year 1. Dividend is 20. It will increase by how many percent? It will increase by 12%. It will increase by 12% times 1 point what? 1.1 to raised to power 1, right? Is it 1.12? Am I correct?
1.12.
Okay, 1.12, right? Okay. So the usual way, 1 divided by 1 plus 0.14, 0.14 raised to power of 1, raised to power of 1. Please unmute your mic and ask your question quickly.
Okay, well done, sir. Please, I discovered that this market price, D01 plus D, 1 plus D, cost of equity minus, is different from the cost of equity formula for the
It's
cost of
different.
equity.
I don't understand. It's different from what?
The formula we use, the KE that we use for the equity valuation.
Please, I can't hear you. Just be audible, please. I can't hear you. Serious.
Valuation, the equity valuation, KE, this formula of market price is different from it.
It's different. It's different because this is dividend, and there's a growth in dividend. If you check your notes, I equally state something there. Dividend with growth and dividend without growth. How to determine the market price? Dividend with growth and dividend without growth. And in this question, there is a growth in dividend, which makes us to use this formula as market price. Abdurrahman, we were told that they paid a dividend of 20 naira and it will increase by 7%. So there is a growth. So what is the market price? And that is why we have to use this way. Do you get? I know what happened.
And
Yeah, I know what happened.
instead of
You say? I
then
can't hear
instead
you.
of the market value that we use, instead of the
Yes,
market
they
value,
say,
we now
see,
use
Abdurrahman, wait. I understand you. The market price is per
okay.
shares. If you want to get market value, multiply it by the numbers of shares. It doesn't mean anything. Do you get? So you are not even given the numbers of shares, sir. So there is no, you don't even need to stress yourself. Market price means per shares, per shares. Then if you want to get the value, multiply it by the numbers of shares, we give you the value. But they say share price, so they didn't tell us value. So if they
Okay,
tell
we
us
have
value, you would have been given the numbers of shares.
I will to go
Are we
through
good?
the
Yeah? Abdurrahman.
I've got it. I've gotten it now. So, thank you, sir.
Okay. That's fine. Welcome. So now, quickly. So year 2, this is raised to power 2. Then this is raised to power 2 as well. Year 3, we're told for how many years, sir? Is it 3 years? It's 3 years, right? Class, is it 3 years? My people.
Yes, sir.
Hello?
It is 3 years, sir.
Okay. I guess you are tired, right? But me, I still have the energy. Oh. Guess what? Immediately after this class, I'm still entering another class again. So, so the energy is still there. So please, we'll end this class, maybe by 11:30, right? Maybe by 11:30, right? Okay. So please give me figure. Figure.
$19.64.
19.64. Next.
19.29.
Okay. 19.29. Next.
80.97.
18.97. So what is the total here before we do the infinity?
$57.9.
Right. So we'll quickly do the infinity. 3.
59.
Okay, 0.9. 3 to infinity. So there are two ways. So let's just pick this last, the present value, times we grow it by the day after. Where is the day after? The day after is 7%. We grow it by 7%. That is 0. We grow it by 7%, right? That is 1 point what? 1.07. Is that not so? Then divided by the cost of equity is 14% minus the growth rate is 7%, 0.7. So please give me figure.
255.71.
0.71.
One.
So when you add this together,
313.61.
new share price. What do you have?
313.61.
313.61. Okay, so this is 2 marks. This is 2 marks. 2 plus 2, that is 4. And lastly, interesting. Lastly, as a financial advisor, now don't forget, we were told that estimates who want to quote. Obong PLC recently received a takeover bid from Abdul, right? From Abdul, which means Obong PLC recently received a takeover bid from Abdul. Is that not so? Which means that Abdul wants to take over Obong. And in the A part of this question says that we should determine what is the market price of Obong as of today. Now, the second question now says that, okay, if Obong accepts this bid from Abdul, what is the new share price? Calculate the new share price to the shareholders of Obong, right? And we've calculated that. Now, the next question now says that as a financial advisor, you should recommend to the shareholders of Obong whether the offer from Abdul should be accepted. Class, if you want to make your recommendation, you have to compare the current share price of Obong and when Abdul take over. Is there any increase? If there is an increase, right, you could say that, oh, Obong should accept it. Obong should do what? Should accept the what? The offer, because there is what? There is an increase in the share price. So now let's compare the first share price, which is C. E. Okay. Oh, coming. Obong PLC share price. So what is the share price? Obong PLC, the first one, is 306. Is 306 per shares. New share price if Obong accepts the bid. The new share price is 313.61 per shares. So what is the increase? So what is the increase? What is the difference?
Sorry taking you back. This value for infinity, I'm not getting that value.
You will get it.
So
what is the increase?
That should be 289.
289.97.
So what do you have here when you add it?
347.87.
347.87. So what is the increase? What is the difference?
41.87.
41.87 per shares. So this means that if the recommendation is that if the share price will be consistent, if there will be a consistent increase in the share price, Obong should accept the bid of Abdul. Why? I hope you are writing. The share price as of today of Obong is this. But if Obong decides to say, okay, let's accept this bid, the share price will increase if they accept the bid. As a result of that, as a result of coming together with Abdul, right? Probably they want to merge, right? Now, and what is the difference? And don't forget, I cannot just go and meet, just go and meet exclusive and I say, oh, let's match, let's do business. Or I will call someone now and say, oh, let's do business. Oh, let's match together. I need to know what is your value. What is your value? Now, the value of next gen as of today is 306 naira per shares. Now, if we want to merge with other guys, right, it will be 347 point this. What will be the increase? The increase is this. So which means that I will definitely accept the bid. The recommendation is that Upon should accept the bid if it is highly probable that the market price will increase in the future, will be consistent. There will be a consistent in the increase in the what? In the market price. Case closed. That is your 2 marks. Is it 2 marks? Abdurrahman.
You caught me.
Okay. Okay.
No,
Please put
no,
down your
no.
hands. Just put down your hands. Okay. So
Okay, no.
that is 2 marks. Class, I hope I'm communicating. Then the last question here is in your notes. So you need to, the 3 forms of efficiency market, that is 9 marks. And the total marks of this question is 15 marks. I think I'm done with this question. I'm done with this question. Any question? Please, any question? Are we good? You see, valuation of a business is interesting, right? It's interesting. Should we solve one more question before we go? Or let's just leave it. Maybe tomorrow. We have class tomorrow, right? Wednesday. We have class tomorrow. Should we solve one? Oh, let me check what we have. Let me check let me check the. So this question was tested in, that was the diet I qualified. I think it was, May 2023. The last question there. And if you check that same May 2023, that is why I said, okay, I won't say, let me say this off recording. All right. What else again? What else again? What else again? Okay, let me quickly check. Let's check the next question. This is the next question. This is also one of the question adopted from ACCA as well as ICANN. This is net assets method. The first required is using the information provided, prepare a report for Bolade board. Calculate, this one is also a report. Calculate the value of one share in KOL PLC. One share, that is the share price. They say one share, that is the share price. Calculate the value of one share price. So that is the share price. So you need to calculate the share price of each of this method. The net asset, find any dividend, present value of future cash flow, that is system max. Explain the advantages and disadvantages of using each of the 5 value methods. This one, you should answer this question by us. These advantages and what disadvantages. You can list one advantage, one disadvantage, one advantage, one disadvantage. Why? When you are writing a report, what are the possible benefits from merger between Bolade and Kenny? You can see, I love this. This is merger and acquisition, right? Merger. What is the benefit if I want to merge with you? What should I be expecting from you, right? You're not bringing anything to the table. You say I should come and merge. Who does that? You get, so this is another 6 marks question, right? Then I think that's all. Then the first another question. I think we have more 2 questions. This question and KLPLC. So class, I think I'm tired. Uh, Hello. Please, can you try this question? We'll continue.
Mr. in
We
ministry,
should-
you're tired.
Let's digest the one you thought.
Okay.
We have all the energy
Uh,
to
you said
all.
you have all the so I've not see breakfast this morning. Hi. I've deprived myself. Okay. Okay, that's fine. Like seriously, what should we do? Okay, we have 2 more questions. We have this question. I want us see. I just want you to understand that valuation. In case you see valuation, you know that yes, you can do valuation of a business. So that with this knowledge now, we'll move to maybe if we can be able to solve 2 questions. No, we can't solve 2 questions tomorrow. But hopefully we should finish this question tomorrow, Saturday, Sunday. Saturday, Sunday, okay? So that we can move to merger and acquisition. Okay, class. Should we continue? Or should I analyze this question? If I analyze it, if we come back tomorrow, I'll still come and do analysis again. So your assignment, try this question. I know most of you have the material, right? So try this question, although we'll do it in class tomorrow. But try it. Try this question. Question, I'm coming. Question 5. Sir. Okay. We should continue the play. uh,